want to welcome everyone to Climate Week NYC. We're right in the middle of a lot of stuff going on climate, and really the Green Impact Exchange is really excited to be hosting this webinar, the pushback on sustainability. So we've got a great group of guests here that come from a bunch of different expertises and experiences that are going to really help us dig into the this kind of unusual phenomenon of the pushback on the pushback. And so we're going to dig into that a little bit. I wanted to just acknowledge Knickerbocker Financial. I think we've got guests from Knickerbocker, as well as Schroders, Irvin Financial, and we actually have someone from Green Impact Exchange as well joining us on our panel. But before we get into intros and all that, I did want to mention we are going to try and do a little Q&A at the end. See how that goes. Use the chat to put a question or a comment in there if you'd like. We'll do our best to respond if we can. But before we go into the panel introduction stuff, Dan, are you on? I think you are.
Here.
Leibovitz, the CEO of Green Impact Exchange, our illustrious CEO. Would you want to take the torch?
Thank you, Jim. And good morning, everyone. As Jim said, I'm Dan Leibovitz, CEO and co-founder of Green Impact Exchange. On behalf of myself and the other co-founders and the entire senior leadership team at GIX, I want to thank our panel guests for joining us today to share your knowledge and wisdom. And I want to thank and welcome you, our audience, for joining us. We know that Climate Week has a packed schedule, so we're grateful you've chosen to spend time with us. Our theme this morning, as Jim said, is pushing back against the pushback on sustainability, which is a timely and important topic. Since we started our journey in 2022, bringing the Green Impact Exchange to life has been an all-consuming occupation for the entire team. And each of us feels passionately that capital markets have a critical role to play in helping to meet the UN Sustainable Development Goals and the targets that were set out in the Paris Accords. And like many of you, we have had to deal directly with the pushback against sustainability. It comes from all sides. People who benefit from the carbon economy, or people who fear the transition to a new green economy, people who have political axes to grind and have found environmental denialism to be a useful foil, people who have been burned by false promises and greenwashing, and the list goes on. And I won't lie, there have been days when the weight of all that pushback has been heavy and the temptation to just give up is pretty strong. But what motivates us to keep going has been a realization that at its core, investing is a form of optimism, and investors are by and large optimists about the future. That's why they invest. And so between that and a sense of urgency, that we're concerned about our environmental futures and we believe that working together, there are solutions, that keeps us going. And we're not alone in that feeling. Over the past 2 years, GIX has spoken with sustainability and investor relation teams at hundreds of companies, and we can say with great confidence that the fight for sustainability is alive and well, even if people aren't talking about it loudly. We still have a long way to go, for sure. Every company is at a different stage in embedding sustainability into its business, and there have been varying degrees of success and various obstacles that are yet to be overcome. At GIX, we believe that all companies can be successfully sustainably focused. Some companies need guidance, some need incentives, some companies need access to capital, and some companies just need more visible support from investors to stand up to skeptics. When GIX is up and running, we will help provide access to all of those things. And we've been making steady progress in key areas to make that dream a reality. We're in the final stages of getting approval from the SEC for our exchange license, and I am proud to report that during the public comment period on our license application, we received 30 supportive comment letters and 0 negative letters, which is a virtually unprecedented thing. And we're hopeful for approval from the SEC in the near future. And while we wait for the SEC to finish its work, we're continuing to build our inaugural class of dual-listed companies. We've received lots of interest from companies both in joining from the start and also once we've launched trading. And with events like this webinar at Climate Week, we're continuing to spread our thought leadership around how the direct involvement of capital markets is the missing element that will supercharge the sustainability movement. I spoke a moment ago about optimism, so let me close my comments with what my mother, who was an eternal optimist, used to tell my siblings and me. She said, "Don't believe that old saying that people who can keep their heads about them when things look grim don't understand the gravity of the problem. That's not true. Only the people who can keep their heads about them can face the problem head on and find solutions." She also told us never to give up. Not only is the glass half full, but the waiter is on the way with refills. I'm looking forward to our discussion here today, where our guests will be talking about topics that are relevant to those themes. As we're fond of saying at GIX, tomorrow's blue chips will be green. If you'd like to learn more about us and what we're doing, please visit our website at www.tradegix.com. And in the meantime, I encourage you to enjoy the webinar, ask questions, and hear what these very wise people have to say. Jim, back to you.
Thanks, Dan. That's great. I appreciate it. Just in way of introduction, myself, I'm Jim Ross. I, with Pete Jenkins, co-head equities and market structure for the Green Impact Exchange. My background is completely in the capital market side of things, not the sustainability side of things, but it's been an exciting and very, for me in my career, just eye-opening to merge my passion for making markets better with taking on the challenge of climate change. It's a fascinating development for me. But I was gonna, if my panelists will humor me, I would love it if you guys would introduce yourselves, give a little bit of background as well before we jump in. Shelley, if you don't mind, I'm going to start with you.
Sure, that's great. Thank you so much, Jim. Hello, everyone, and thanks so much for attending. We look forward to a really engaging conversation. So I'm Shelley Goldberg. I'm the Chief Green Officer with GIX. My background is entirely in global macro portfolio management with a focus on global resources and commodities. I spent many years on Wall Street, starting off on the sell side, gravitating toward the buy side. I ran an energy hedge fund and a sizable fund of funds devoted to the sector after finally becoming a commodity strategist for Nouriel Roubini as well as Brevin Howard. I then formed my own consultancy focused on the E of ESG. Fast forward to the end of 22, I narrowed down all my clients to my favorite, which is GIX, and now my current employer.
Great. Marina?
Yeah, hi there, Marina Severnowski. I'm the head of sustainability for the Americas region for Schroders, and Schroders is a almost $1 trillion asset manager that's based in the UK. So I also started on the sell side in investment banking, and then actually at Schroders spent about a dozen years on sort of different investment desks in commodities, emerging market bonds, quantitative equities, and I was also a market strategist. And then I moved into sustainability here at the firm right around the end of 2021, 2022, beginning of 2022, which will have some relevance, I think, to this discussion. And I oversee kind of our integration efforts and also our communication out to clients about what we do in sustainability.
Fantastic. Thank you, Marina. Andrea.
Hi, everyone. My name's Andrea Schmitz. I spent 6 years at the U.S. Environmental Protection Agency as a regulator, and then I switched to the regulated side, and I spent 25 years here in New York City at Con Edison, and I retired a couple years ago as Vice President of Environment, Health, and Safety, and I now work for Knickerbocker Financial Group and sort of run our ESG practice. I'm glad to be here.
Fantastic. And Dave.
Yeah, hi. Thanks for joining, and thanks to GIX for having me. So like Jim, actually, most of my background is in capital markets and market structure and finance. So I'm currently the co-founder and president of the board at Irvin Finance, where our focus is bringing together individual and retail investors and public companies, two of the parties that markets are really supposed to serve, and allowing them to engage with each other at scale. Before that, I've spent a lot of time in doing a lot of quantitative research and high-speed trading in markets. That's where I started. I've worked with exchanges, including IEX and in Canada, Equitas Neo, who are trying to change markets using exchange, from the exchange perspective with private market solutions. I've worked closely with regulators. I've done advocacy for market structure reforms, and I have served on committees such as the Market Regulation Committee for FINRA and the Market Structure Advisory Committee currently for the Ontario Securities Commission. And I've also worked a lot with institutional investors, helping them put better governance policies and procedures into practice. So, environment, the ESG side of things, most of my focus is really on the G, and I often feel like that's the forgotten part of ESG. So I'm happy to talk about that today.
Super. Thank you all so much. And Dave, Shelley, Andrea, and Marina, welcome. We're very honored to have you guys, for no doubt. We're going to have something to talk about. So the pushback on sustainability, I got to say, this morning I got an email from our head of market strategy with an article, and boy, was it fortuitous. And I'm going to paraphrase, but I think the title was in Barron's, "The Pushback on Green Finance, on the Death of Green Finance. It's not dead, it's booming." You can't obviously even pay for that kind of advertising, but clearly, no doubt, it's kind of a curious thing when you imagine pushback on a pushback. Usually one pushback is enough to stifle any good movement, but it is interesting that we are experiencing now that I would call it a certain tenacity, if you will, and resilience to sustainability and the climate movement. But before going into kind of that, where we are today and where we're going, I wanted to, Marina, if I could start with you, talk a little bit about kind of how we got here a little bit in setting the table in the past. Where did that initial pushback, if you will, kind of evolve from, and what were some of the, Dan kind of alluded to that it's not just a political thing. There's several factors driving the initial pushback, and I was wondering if we could maybe start off talking about that.
Sure. Thank you. And this is a topic that I speak on fairly frequently. And in the beginning, it didn't kind of get me a lot of friends, but I think things are coming around to that same view. I hear this now from other folks about self-reflection as to kind of how this began and do we have a role, in how it began. So as I said, came in as an outsider at the end of 2021, having been on the investment side, having been sort of a consumer of sustainability support, from my central sustainability team. And I think about the arc of kind of how sustainability permeated for us at Schroders, but in the industry overall, that if we look past the very kind of like the legacy, sort of more religious-based investors, right, the kind of responsible investing movement, which dates back many decades, that the modern sort of sustainability movement, somewhere around 2005, 2007, Schroders was reporting to CDP in 2005. We were a founding signatory to PRI in 2007, and this even the kind of the acronym of ESG, right, being coined kind of around there. So we talk about being like in the teenage years now. We're a teenager, which is a tough time, for anybody. But the reality is that sort of over, it was kind of slow and then very quick is how we experienced it as investors. That right around 2017 or 18, it really, really took off. And I think it was very supported by the market environment. Again, at the time I was a market strategist. And so you were seeing an environment of sort of growth, investing over value. You were seeing kind of, low interest rates, low inflation. A lot of the companies that were doing very well were sort of framed as good sustainability companies, but in reality, they were sort of large cap growth companies, largely in the US, that happened to align to being fairly low carbon intensity companies, at least sort of scope one. They happen to have fairly educated workforces and have kind of, good dynamics from the S perspective. So like no mine workers to worry about their safety or things like that. And then from a G perspective, they're larger companies with capital, right, to be able to publish good, disclosure and good policies and lots of lawyers on staff. And so there was a coincidence or a correlation, right, rather than a causation around what we sort of defined as sustainability. And a lot of what took off in terms of money coming in was chasing good returns in passive sort of indices, where if you looked at a large cap growth fund, kind of US focused, and you looked at like a sustainable fund, it would be hard to distinguish one to the other with the top holdings, right? And I think that when you're succeeding that way, when there's a boom, it's very easy to sort of see yourself as a genius. This is like the pitfall of investing in general. And I think it's very hard to have humility and to sort of recognize that you're probably leaving somebody behind and that it won't always be this way, right? The markets are very cyclical and you won't always be on top. When I started in the role in 2022, and you can actually look, I had written a paper that talked about ESG through a US lens. And I identified sort of 3 problems, and this was before the backlash really started functionally in 2022, in the way we talked about climate or the way we approached climate with people who sort of, not that they disagree about climate change, but people who are hurt by transition, right? How we approach it with them without the empathy and the respect that's needed to recognize that change is going to be very hard, and how do we account for that with them? The second issue is that we were leaving behind some of the social pieces. And now we recognize how kind of embedded that is, right? That we can't talk about any of this transition without talking about social equity. And the third one is that we were framing things much too much about kind of sacrifice and what you have to give up versus opportunity. And you just talked about kind of green finance as this sort of great opportunity. And I find that even people who don't want to talk about sustainability want to talk about opportunity, and they're willing to talk about those opportunities too, because those are just investment opportunities. They don't have to be framed around kind of the issue of climate. So those were the things that I sort of saw as problematic. And I think all of those kind of exploded on us in the sense that, you know, we were not respectful and empathetic enough to people who were going to be on the bad side of the trade, right, in transition. And we did not frame it enough as an opportunity, an investment opportunity, a real kind of, look, the world is changing. These are the big trends. This is how we can harness those trends and take advantage of those trends. That's the exciting discussion, especially I think in the US, where the US psyche is focused not on kind of how you get constrained and like the shame and sacrifice and guilt. It's very focused on opportunity and kind of a positive version. And I think that we left, like I said, people, we would talk in these rooms in the beginning in 2022, some of the first conferences I went to, people would say things like, well, we all get it here, but the people out there, they don't get it. And so you were othering other people. And again, that's always going to come back to bite you. I think in the last 5 years, there's been a kind of a humility, right? Because the tailwind is not at your back. And so you have to then reframe, again, how you join hands with others, how you, have to defend your position, all of which is a really important learning opportunity. And as I said, it's the growing pains of sort of teenagedom, but you come out stronger as an adult, I think. So I think that's where it began. Now, there's obviously unscrupulous politicians who will take any situation where people are clearly worried and anxious and disaffected. We have plenty of that in the world. And they'll sort of take advantage of that, right, to frankly be reelected. And so we've seen a lot of that. And I think the solve or the kind of solution for that is obviously to build a stronger foundation where, again, you remember to be humble, you remember to be respectful, you remember to be empathetic. And I do think that we as an industry are doing that going forward much better. I mean, we're participating all week in Climate Week, and people are talking about just transition, sort of social equity, all of these things that we probably should have been talking about 5 years ago when the wind was at our
back. Right. It's interesting, and I think we're definitely going to come back to part of that, the honing of the argument and refining of the mission and of sustainability and how we have to be more inclusive. I want to hold that for further, because I think it's a very important point. Andrea, I was hoping I could, I know you had some time at the EPA, and going back to, what kind of initiated a lot of this pushback. I was wondering if you could opine a little on your experience at the EPA and just the role of regulation in, the government role in starting to, press forward with regulations in support of sustainability and addressing, the net zero side of things, and how that also kind of galvanized some of the response. What are your thoughts on that? Does that have a factor here or not?
Yeah, thanks for the question, Jim. And I really liked a lot of what you said, Marina. That was really interesting. So I think public companies at large are concerned about regulation, but the big thing that they're looking out for are issues that are material to them on the environmental side. What affects the bottom line? And let me give you 3 examples of how they kind of interpret that information. One is certainly regulations. And remember, core regulations from EPA still exist. You have to ensure clean air, you have to ensure clean water, you have to properly manage waste. Companies know that these regulations are here, they're not going away, and companies need to respond to them and continue to watch out for issues that they have in their own operations. So that's first. Second, boards are smart about climate now. They're going to ask their companies and they're going to say, are your facilities resilient? What's going to happen in this storm? Are we going to lose a factory? Are we going to lose operations? Tell us about that. They're going to say, are we wasting money on electricity? Why can't we be more energy efficient? So companies have to respond to that. That's kind of the governance piece that Dave might be alluding to. And third, and I'm actually pretty excited about this, the era of greenwashing is ending. So the SEC has put in place a number of fines. I want to give you a couple examples. One involves one of my favorite things, which is coffee. So Keurig was just recently fined this month $1.5 million for saying that their coffee pods, the things that I love so much and drink 4 of a day, can be recycled. But you know what? They're not accepted by major US recycling companies. So they were fined this month by the SEC $1.4 million. Another example, Deutsche Bank fined $19 million for ESG misleading statements. That was last year. I think it's the largest greenwashing penalty that I know of. And before that, interestingly, Goldman Sachs fined for not following its own ESG policies, fined in 2022 $4 million. So companies need to pay attention to all three of these items. And I think that is going to continue to drive the environmental movement in a positive, very optimistic, very forward-leaning manner. So again, I am very optimistic about the future of sustainability.
It is an optimist tale, is it not? I think that's coming through. As the story of resilience often is. So Dave, I know, on the governance and retail front, I'm curious kind of when we think about the backlash, initial backlash and all that, obviously consumers and investors are a big part of this. And a lot of this is about, demand-driven type of experiences. We'll look around your room you're in right now. We're filled in a room full of plastics. The computer screen we're talking on, plastics. And, the cars we drive and all that. So I was wondering if had any thoughts for kind of looking at this from the retail and the consumer side of the equation and their role in this initial backlash, or are they part of the reason companies are backlash because they want to own the retail investor and consumer? What are your thoughts on that?
Yeah, I think it's a really interesting way of looking at things. And, clearly this backlash happened. And what I think when you dig into the numbers, the backlash was really from from older people, frankly. I think what companies have started to see over the intervening years is how dramatically different each generation looks at these issues, how dramatically differently they look at these issues, and that there's this tremendous bottom-up demand from both consumers and employees and shareholders that is now driving these companies. And it's these sort of three parties that, regardless of sort of political polarization and all of that, and whatever's memed right now, or whatever extremely online people are talking about, what you're seeing is consumers speak with their wallets. You're seeing shareholders invest in companies that they care about and that express and live the values that they want to see these companies embody. And you're seeing employees choose to work at places that embody these values. And so, just like I've got a bunch of stats to talk about as we go through, but one really good one. There was a US bank study that, and I'll talk about this a bit later, but over half of Gen Z and millennial investors will only invest in businesses that take a public stance on certain issues. Right. So this is, and it's easy, I think, for many people to dismiss younger investors. We see it all the time, without realizing that this idea, this great wealth transfer that we've talked about for many years now, is happening today. And it is this massive, in the US, $84 trillion is flowing right now to younger generations, to millennials, to Gen X, to Gen Z, and they see the world very differently than baby boomers do. And so, I think what companies are starting to see and recognize, both in capital markets, but in their sort of day-to-day experiences with their customers and their employees, is that a lot of people see past the political rhetoric. A lot of people care about these issues, and frankly, they will not patronize companies who don't stand up and aren't sustainable, and they won't invest in companies that don't do that. And they're willing to accept lower returns on their investments, these younger generations, if it means that they're investing in companies that stand for what they believe in. And so I think that's a huge piece of the pushback to the pushback, that's sort of normalizing this stuff, because these younger generations, they care about the world. They care about the world they're inheriting. They're concerned very much about it, and they want to make sure that the companies that they invest in also care about it.
Yeah, it's fascinating to really think about. It's a bit of kind of at the crux of it is merging the need for financial performance, which we've all, since the history of capital markets, become accustomed to. And so have all portfolio managers and investment managers delivering those returns, alongside more of a purpose-driven type of mindset. And that, as you were saying, Dave, the idea that yes, I want financial performance. I'm not giving up on financial performance. I still need returns, but I actually do care about, are the things I'm investing in, are they abiding by certain sustainability norms and expectations? And it seems a little bit, and Shelley, just tapping into some of you've been the one talking to what Dan was saying, those hundreds of public companies, and trying to figure out that balance between that image of we're going to bring you, we're a public company, invest in us, we're a worthy financial investment, but we're also sustainable too. And how does that narrative play out in the conversations you've had with those hundreds? I mean, literally, you've had hundreds and hundreds of conversations with the chief sustainability officers, but also the investor relations and the CFOs. How does that play out?
Yeah, absolutely right. Thanks, Jim, for pointing that out. My colleagues and I at GIX, as you have said, have had hundreds of conversations with C-level executives, including CFOs, CSOs, and heads of IR. Despite this anti-ESG rhetoric and the politicization, we're hearing that they're spending between anywhere from $250,000 to $480,000 and upward annually on sustainability reporting, and they're not turning back. Rather, what they're trying to do is leverage that work that they've capitalized on. And, a main driver of that is attracting capital. Morgan Stanley showed through their data that in 2023, sustainable funds continued to outperform their peers. The market grew 15% last year, reaching to a high of 3.4 trillion. And, over 50% of investors plan to boost sustainability investments this year. And when asked if they were interested in this investment strategy, 77% gave a resounding yes. So, listen, the world has invested $2 trillion in climate finance, and that's more than double the amount in fossil fuels in the past year. Among 3/4 of executives, they expect climate change to affect their business strategies or operations within 3 years. That's a study according to Deloitte. And, here's how they're taking action. 85% have increased sustainability investments. 45% are embedding climate change considerations into their business. And, sometimes you think, well, larger cap companies tend to have more capital, human and otherwise, for sustainability. Yet, smaller companies can make waves in this area too. And the reason is successful embedders aren't buoyed by big sustainability budgets. They incorporate sustainability and data insights broadly into other spending and investment decisions. In fact, IBM said that companies that embed sustainability spend less on dedicated sustainability efforts as a share of their revenue compared to organizations that don't embed, yet they incorporate sustainability considerations and data insights in 22% more of their operation decisions. You know, it's interesting because we're seeing a lot of additional interest in adopting, you know, SASB, for example, has grown significantly. The Russell 3000 has jumped from 29% in 21 to 73% this year, and S&P saw an increase from 82% to 94%. So you're seeing this in other standards as well, like CSRD. So again, the train has left the station. Companies are not pushing back on this. They want to capitalize on the efforts that they've made.
Indeed. No, that's a great point. It does seem that in the earliest of days, you know, with Inconvenient Truth and all those, that there was a certain amount of disbelief, and that obviously resonated with the science as well, and questioning the science. And clearly there was a lot of just misinformation and again politicization of the situation. But it does seem that, to the point about the train leaving the station, has just pushed right through that that doubt and that conspiracy theorism that seems that early on came on the way. But it's interesting today, and Andrea, I was hoping you would speak a little, because you have spoken in the past about your experience at Con Edison, and I think it's a tale worth hearing, if you wouldn't mind. The experience that you had while you were at Con Edison as a corporate provider, as it were, in this way. And I was hoping you could maybe talk a little bit about that.
Sure, sure. So I think the key is that smart companies know what's material to them, and they're going to address it. So the way I came to Con Edison, I was at the Environmental Protection Agency and was working on methane, and I had met Con Edison. And back in the late 80s, for those of you who were in New York City at the time, Con Ed had a steam explosion at Gramercy Park and did not report asbestos on time. And that basically made the company an environmental felon. And so the company took a very hard look at themselves and said, what do we need to do to turn this around? And so in the mid-90s, they hired people like me from the Environmental Protection Agency. They put me in the Bronx and said, hey, start an environmental group for gas operations. We're going to give you a few mechanics, a few supervisors. And the focus at that time was on how do we ensure that this spill issue never happens again? So that material issue was all about how do you create the procedures, the policies to report spills, the infrastructure to respond to spills, for mechanics on the street to be able to clean something up that they spill on their own, or to call for additional resources. And how do you work with regulators? And then the board said, let's make this an indicator. And if you have too many late spills, all of you management employees are not going to get your bonuses. So that infrastructure, which had a lot to do with governance, which I'm sort of quoting Dave, but it made the company responsible, accountable, and put into place those policies, procedures, those mechanisms, the training, and really the understanding from the CEO to the new hire in a mechanic on the street to understand why that's important. And I think what you do is you find those material issues, and then you build on the next one, and you build on the next one. And that's the kind of evolution that smart companies are doing. And that's one of the reasons. And this affects the bottom line. If you don't do it, your company, to Dave's point about investors and people who want to go work there, they're not going to come. You're going to be in trouble, and you're going to have to swap out with someone else. And then that expands to other parts of ESG, like employee safety, public safety. How do you create a diverse workforce? So that's been my experience. And I think when you really focus on that really important issue and you address it, everybody's better off.
So you know, taking the theme about corporate governance, Marina, on how you look at it from an institutional perspective, as obviously one of the larger, if not one of the largest investment managers in the globe. I mean, how do you guys think about corporate governance and sustainability? How is that practice embodied in kind of not just your messaging, but in your kind of investment strategizing. And when you talk inside your offices about how we're going to incorporate this, how does corporate governance factor into that for you?
Yeah, I mean, the G in ESG is like the granddaddy of them all. It was sort of where we even began with our own investment teams. We have 60 different investment teams at the firm across all different asset classes. And the way we've integrated sustainability kind of analysis of both risk and opportunity has been through those teams. We've not sort of forced it from the outside, from a central team. We really worked for a decade plus to co-opt them. And then the G was the place that they understood from the very beginning. They understood things like management quality. They understood things like shareholder friendliness, right? And they were engaging, quote unquote, on those things already, even though it wasn't necessarily being called engagement. So I think, we're still there. I mean, for every issue that we think about for an organization, for example, very big today is kind of nature and companies understanding whether they are dependent on natural sort of resources or whether they're obviously doing damage, right? And we look at board level understanding. There's a like water scarcity, for example. Is there a water policy, and that is the board responsible and accountable for that. We look at compensation. We look at, but obviously, kind of talent management, sort of planning over time. We look at on the DEI side, right, on sort of board diversity and all sorts of, again, human capital sort of issues. So, I mean, governance, again, is always in play when we sort of think about, when we talk to a company about anything on the kind of sustainability, the social or the environmental side. We really are looking for materiality, right? What do you think are the material risks and the material opportunities in your business? You identify them for us, right? You tell us, your business. And then anywhere that you tell us these things exist, what is the governance around that? How are you managing that issue? It's not enough, obviously, to just say it. We have to see that again, for example, compensation being aligned, right, to those initiatives, those targets. So I think that's kind of, again, how we approach. I think governance is literally wrapped around all of these things. That's how you can tell that a business is taking it seriously, and that it isn't just sort of spin, right, for the benefit of the kind of shareholder conversation.
So yeah, and Dave, obviously you brought the governance thing up. I'm curious what, obviously the retail investor is in many ways activist, even more so certainly than probably the institutional community, even though they do their proxy, shareholder proxy stuff. But that we've seen with the meme stocks, right? They like to make a statement. They want to make a statement. When we think of trading nowadays, we always think about, am I getting best execution? But in many ways, we hear this story from retail that they want their trade is not just a financial transaction, it's a vote. And I wanted to ask, just how do you see that relevance between the retail investors' activism and their view, if they have one, and I think they do, or maybe you'll tell me, vis-a-vis governance?
Yeah, and it's funny because I take what Marina just said to heart, that like from the institutional perspective, governance has always been like the foundation. And I think that's like a very healthy way to look at ESG, that you can't do anything without governance and a strong governance structure. But sort of from the popular side, the social side, the retail investor side, ESG basically just means environmentalism, right? And I think that as over the last couple of years, as we have seen a couple of things happen, we have seen this new presence of retail investor in markets to a degree that they have not been before. And it's not something that was a passing phenomenon. It's not something that stimulus checks went out in 2021, a bunch of people traded some meme stocks, and then that was it. In fact, today, the percentage of trading of retail investors is higher than it was in 2021 and higher than it's really ever been. Retail investors are a more significant part of the cap table than they've ever been before. They own larger pieces of companies. For some companies, they have a very large piece of it. The ones you're thinking about, GameStop, AMC, these companies where people care about these companies and they invested in them for all sorts of reasons. And it's not worth getting into, but what we have seen over the last few years is that the reason they have stayed in those investments is because, one, they love these companies, and two, they see themselves as having saved some of these companies in the midst of COVID from bankruptcy, from attacks by short sellers and such. And now they really feel that their presence is critical. And you see these really dramatic efforts to marshal individual investors and get them to vote. And for a very long time, the idea has been prevalent that retail investors don't vote. You ask any company and they will tell you they don't vote. But what we have seen time and again in the last few years is that is absolutely not the case. And you can get massive turnout. You can sometimes get more votes cast than there are shares, which is a whole other problem in markets and not worth yelling about here. But what you will see is when a company engages its investors and shareholders actively and regularly, or when those investors form communities online oriented around these companies, that's when you see them vote. It's not when you receive something in the mail once a year and it's just this paper proxy that you're not tapped into what this company is doing. You haven't had any outreach or engagement from them, and you really just don't care that much and care enough to take an action that feels very foreign to you. Younger people engaging in things through paper mailings is not happening and will not happen. But when you engage with them on their phones, which is where they're at, and online, then you can get them to take action, to care about what companies are doing, and to vote. Disney saw this recently when they marshaled their retail shareholders to fend off an activist proxy battle. Other companies, Tesla is another great example. Regardless of whether you agree with these companies or not, they have found that they can marshal their retail investors who usually you can see two different things. Often they will agree with management, and for a company, it's a very worthwhile thing to do to engage with retail investors. And you can now do that at scale, whereas you really couldn't do that before. And that's what my company does. On the other side, you see activist campaigns. We talked about one before this, but there's this group called As You Sow, and they marshal retail investors for the sustainability initiatives that are being brought to vote at annual general meetings, and they're seeing success as well. And so from both sides, you're starting to see a really dramatic shift in engagement of retail investors, and you're seeing them vote when companies or other efforts make an effort in a different way than what we have, I think, traditionally seen in markets.
Oh, indeed. That's fascinating. The role, I do feel I have to ask a question about greenwashing. It is part, right, of the pushback. It has to be. It's part of the initial pushback as well as also the response. And Shelley, I was wondering if you could just chat where you see greenwashing as it stands today. Have we, obviously there are some cases that some litigation, and there's been some confronting greenwashing for sure. Is greenwashing fading? Is it continuing? Is it evolving? What's your sense on where greenwashing stands today?
Well, I think that greenwashing is very problematic, although it's being pointed out and recognized more. What has kind of moved into the space of greenwashing more so is green hushing. And many of you, I'm sure, are aware of what green hushing is. But basically, green hushing takes place when corporates underreport their sustainability initiatives for fear of backlash by downplaying or suppressing a company's genuine environmental interests. We're seeing that more and more, and it's problematic. And I would say part of that is that greenwashing can be detected through careful scrutiny and fact-checking. Green hushing, on the other hand, has more shades of gray because, it's obscuring the true extent of a company's environmental commitments. So, we know this is serious, but despite the fact that this is taking place, several of the world's largest companies are still increasingly setting significant climate-related targets despite this political backlash. In fact, North American companies 79% now are showing significant climate targets, up from 6% last year, with Europe leading at 95%. So, one strategy is simply recognizing the dangers of green hushing, and greenwashing. We all know the dangers around the environment, and we know the dangers around lack of information for stakeholders. But let's talk about dangers to actual companies of green hushing. You're seeing an opportunity loss because you're losing out on the various stakeholders that do want to identify true sustainability companies. You have the it can damage your brand image because green hushing actually erodes public trust in corporate sustainability commitments when companies don't report on their progress. You also you run the risk of bad press and negative social media. Companies may shy away from sharing their progress for fear of criticism, but failing to share this progress can lead to negative commentary from the media, customers, and, frankly, even your competition. And it has the effects of slowing down or even reversing progress because, green hushing can have this domino effect of encouraging other peers to green hush. And if companies in one sector hold back on communicating their net zero progress, there's this collective pressure within the industry to do so. So companies may even quit on their climate goals and thus impede upon the collective process towards a sustainable future. And then I would also say that, as much as regulation is important, regulation tends to punish companies as opposed to reward them for their, good efforts. The more that green hushing or greenwashing takes place, that will only incentivize regulators to up regulation.
Right.
Jim, sorry,
Please,
if I may
please.
just jump in for a moment. I just want to speak for, again, maybe the unpopular opinion, but on greenwashing. I know it is very in vogue to police this now, and in some cases, very valid. Right? We don't want people out there misinforming intentionally, but I think the oversight and enforcement has to be proportionate, and it has to recognize the realities for firms and for investors who are navigating a very complex and rapidly evolving environment. So I think disproportionate enforcement, and I mean this by sort of like officially on the regulatory side, which obviously we're dealing with in different jurisdictions, but also us all kind of collectively socially policing, right? Perceived greenwashing, I think it undermines investment in transition because there are a lot of data gaps that persist, and it's an evolving nature, in the field. And so, you can make decisions as a corporate or an investor in good faith based on the available data and the analysis that you have, which could turn out ultimately be flawed because there's new data or insights that emerge. And so we have to reflect that reality. And I think about that again right now, like during Climate Week, nature is a big topic, and there's so much analysis paralysis or fear, frankly, on the part of companies on nature in particular, because there's even worse, right? There's even worse data gaps there. So I think you have to toe this line. I think Shell's completely right. I think both green hushing and greenwashing are problematic, but we don't want to be so zealous, right, in kind of hunting it down on the greenwashing side that we just spook people entirely, all the way to the other direction, where again they're kind of afraid to say anything, even if they have information to give. So I think there's a fine balance, and again, intent should really matter. Is there good intent to disclose, to be transparent, versus ill intent to mislead?
Well, it's interesting. It kind of brings us back to your point earlier about the inclusiveness that needs to be part of the current and future response to even greenwashing, and that we have to be not vilifying necessarily. We need to be incorporating and collaborating the broad group. I think we found this in my observations with the Green Impact Exchange, where anyone can list on the exchange, and we particularly are very interested in speaking with the energy complex and seeing what we can do with them. I mean, if it's not just about solar and wind companies. This is really about the broader economy and the various sectors that are reliant and might need some help. And instead of punishing them, like you were mentioning, Shelley, it's really about including them and making an inclusive approach to sustainability. it's good for all companies, not just the new greenies out there. So but so let's in the time that we have left, I wanted to turn a little bit about looking forward and where we're kind of where are we going with now that we're in the midst of our second backlash. And it's this kind of, as I said, it's almost a reaffirmation of sustainability. It's a very optimistic moment, I think. And I guess part of the thing, that which doesn't kill us makes us better. I've heard that saying. But the idea that you know, where do we take this, and the inclusiveness, Marina, that you mentioned, like how do we imagine the sustainability starting to unfold in our movement forward with investors, with public companies, and the like. And Andrea, if I could start with you, you know, what's your where do you see the kind of the new movement of the resilience of sustainability echoing through the public company kind of environment? How do you see this kind of move going forward?
Yeah, I guess I see two general themes. One is on disclosure. Disclosure drives results. And so if you aren't careful about and accurate on your disclosure, and you tell the good, the bad, the ugly, you talk about where you are and where you want to go, and that will drive results. It'll drive investors, and it'll drive the folks that you care about, your customers, your shareholders, all your stakeholders. So that's number one. Companies need to really put some time into that and make it their own, make it about their material issues. The second thing is, when I look at sustainability and its evolution, I really see technological innovation as something that's going to be huge. Let me give you a couple examples. Back in the late 1800s, 1882, Tom Edison created a power plant here in New York City. That power flowed one direction, from the power plant to the customer. Just in the past decade, there's two-way power flow. That just blows your mind as a utility worker. Now you can a homeowner can take power from the grid at one time and then use their solar panels on the roof to feed the grid on another time. So this is driving all kinds of things: storage, microgrids, all kinds of revolutions in electricity. The second example is on measurement accuracy. And there are things now that are on the methane front. Methane is just natural gas. Satellites can now measure methane emissions in ways we never thought possible. Real time, telling you where the location. This is great stuff. This is the key to accuracy, disclosure, and really making a difference. And then the other thing that's a big unknown is some really big tech. Nuclear is coming back. I think with these small modular units, they might be both safe and obviously a clean energy source. So there's a lot of new technology that's going to revolutionize the space. And to Marina's point, there's going to be winners and losers. But if we can kind of evolve people into to this transition, to this new technological innovation, the planet's going to be better off, businesses are going to be better off, and overall, you know, we're going to lift the economy, we're going to lift the environment. It's going to be good for communities. So very exciting stuff, I think.
Optimists unite. I get it. That's great. Hey, so Dave, let's talk about our retail folks again. You know, we want to you know, get them engaged, fired up, thinking about the future, feeling that their vote matters, feeling their investment matters. How do we see that moving forward in the sustainability front for the retail investor?
Yeah, it's funny. You know, I couldn't agree more with what Andrea said, but you know, I take technology and disclosure, and I look at them from a different perspective. You know, and to me, technology is the answer here, Jim. And you know, it is technology that will enable companies to engage with their retail investors at scale. You know, for a very long time, a public company, has looked at its cap table and said, okay, here are my top 10, 15, 20 institutional holders. I'm going to engage with them. I'm going to, you know, talk to them. I'm going to present, you know, send them information. I'm going to provide them access to management, that kind of thing. And it's never really been possible to consider retail as one of those sort of entries on the cap table, and now it is. And that's what technology allows us to do. And so from an engagement and a governance perspective, again, as we think about this massive shift that's going on, and the completely from a wealth perspective, and the totally different perspective that millennials, Gen X, and Gen Z have towards these issues, you're seeing companies today understand that their individual investors care about different things, and understand that those individual investors are such a tremendous untapped resource for public companies. They're your biggest fans, they're your best customers, and when they provide stable cap table, when they are sticky long-term investors, that gives you a better cost of capital, lower cost of capital as a company, and it means that it's easier for you to grow, easier to raise money, and it's a huge advantage. That the companies that can marshal this part of their cap table are going to have a huge advantage over those that can't. And it's both technology, using technology to engage with them, and then seeing broader themes, broader trends of disclosure and standardization happening across the world and across regulatory agencies, and private market solutions to provide some level of standardization, and the idea that technology can be the linchpin there as well. And when you get standardization along with advances in AI and other tech, it really changes how companies can assess, manage, and report on sustainability, and how we can verify and analyze that information. So to me, that's what pushes us past this sort of concerns about greenwashing. And we know that that when companies are disclosing, it's standardized, it's verifiable, and we can build models to evaluate them and understand them, and invest accordingly. And it's creating this great ecosystem of companies living up to the standards that they preach, and what their investors and their employees and their consumers want to see from them.
So it's empowering the retail investor. There's no question technology is the great democratizer of capital markets, right? I mean, we've seen that over the past 20 or 30 years, 50 years maybe. So Shelley, I just wanted to give you, we got a couple minutes left, but I want to give Marina the last word. But so think of something really poignant, Marina. But Shelley, what's your view on kind of how things are, what are the things we need to kind of move the sustainability movement forward in the coming years? What are the highlights that we got to think about?
Well, I would agree with Dave that technology is really key. And of the big umbrella of technology, one of the spokes, of course, is data. And I think data is crucial because everyone wants to make claims, but without anything to back it up with numbers, they kind of sound like empty rhetoric. So, for example, when you're talking about the environment, so many people think it's limited to GHG emissions, but let's talk about, including things like nature and water and regenerative agriculture and biodiversity loss, and let's report on that. And, companies should be recognized for these efforts. Take the circular economy, for example, which is reusing, repairing, refurbishing, and even sharing and leasing products and materials. Goldman Sachs has named stocks that are exposed to the circular economy as their top picks. So if you're a public company taking action in this regard, why would you want to hide that information? Showcase it. And I would also say, with respect to data shouldn't be collected and managed simply for the sake of compliance and reporting. Neither of those guarantee that sustainability is going to drive value. Data collection without action perpetuates this kind of false impression that senior teams are focusing on sustainability when they may not be. Instead, teams need sufficient resources and upskilling on how to feed sustainability data into their overall strategy and integrate it really into all parts of management to drive capital allocation decisions.
Indeed. There's no doubt. There's a little bit of challenge there for a whole nother webinar on the green data fog that's out there. Challenges to making the data meaningful and useful. But I will save that for another time.
Indeed.
But Marina, last word to you, if you will, and forgive, I apologize about the Q&A. It was just too interesting to hear what you guys were saying. I do want to offer that we will, of course, we want to hear from folks. So after this concludes, maybe we can take some emails or whatever, but and answer some questions. But Marina, if I may turn to you and kind of the last word on this, looking forward from your perspectives or your perspective and Schroeder's on kind of what are those key elements that we need to kind of move this from an institutional perspective and sustainability perspective.
Yeah, absolutely. So I was gonna give, like, you asked for like a really good nugget. I've got like literally a nugget, which is the completely scientifically incorrect quote from Henry Kissinger that a diamond is a chunk of coal that did well under pressure. By the way, coal, right? Like, very apropos.
Yeah.
It's uncomfortable. Like, what we've been going through the last couple of years is uncomfortable, but it's actually very necessary to kind of polish the stone, right? Like, so that we come out better. And I talk about, again, investors from that perspective, but also the corporates, the reporting companies, right? For us, our investee companies who we engage with. I think it is a really, maybe because I'm in the middle of Climate Week and going to lots of events, I think it is actually a very optimistic moment moving forward. On the first piece of it is around disclosure. It has felt like an alphabet soup in a really challenging environment for years, but you're starting to see coalescence. You know, we've seen the CDP out and about, speaking this week. We have obviously ISSB, kind of S1 and S2, underneath that. Again, these things start to come together, right? So they're like the relevance of, you're able to then report as a corporate again, and then as an investor, you're able to report on the basis of what you're getting from your corporates. So we have TCFD, we have TNFD. I was just looking at my calendar. So on Friday, I'm part of it's the newest of the initiatives, which is the Task Force on Inequality and Social Related Financial Disclosures. That's TISFD. So as these things coalesce, there's going to be, again, sort of structure, right, in terms of company disclosure. We are seeing in most jurisdictions around the world a regulatory mandate around that. So again, if you can kind of measure these things, you can assess their materiality to a business, and then you can make better decisions on top of that. I'm mindful of like the way the discussion has been today, which I've absolutely loved on the sort of retail investor side. But obviously, there's still a lot of money sitting on the kind of institutional, right, the big kind of pension side, where we values and aligning to values is still not like the kind of bulk of the discussion. It is really about what it makes a business more durable for 30, 50 years out, right, for as investors, for pensioners. And that, I think, is the most important thing. What's been really positive is I've engaged with our investee companies, and I've actually, at the end of every engagement, I ask, like, you have shareholders like us who really want you to be doing, transition planning and like all of these things, but you have other shareholders too, and they're probably pushing you in a different direction. And kind of how are you dealing with that? And I really love the conviction that I've gotten from companies across all industries, all sectors, who are saying, these are mission critical, business critical things for me, right? This is our operational risk and opportunity. This is kind of reputational for us, legal, regulatory. This matters to our stakeholders. Here's why this matters. So they really have, again, it's that kind of coal under pressure. They've been pressured, and they've come out with, like, we know where we need to invest and why, and we can defend that. And if they can, then we as investors in them also can, on the basis of financial materiality, our fiduciary duty, right? Like, getting, again, that sort of durable, like sustainability in its other definition of sort of durability and better outcomes over time in a world that's changing. So again, I think it's a very positive message. It's not felt comfortable, but we just need to get through that. And I think the next stage is, a much more like a recognition, right? That this is just fully baked into being an investor, or obviously on the corporate side, right, to sort of being a going concern that is resilient and durable over time.
Right. No doubt, sustainability has upped its game. I think that, my feeling on this as an observer of this and hearing you folks speak about it is just, it's really, the pushback on the pushback is really fine-tuned our approach, our mission. We've made sure our data is accurate and it's cut, it's clean, it is, and it really empowers the sustainable movement even further. So, hey, look, you guys, it's humbling to be on a screen with you, but to hear what you have to say is it's so engaging, and I think our audience certainly is benefiting just from getting the different perspectives and stuff like that. I want to just thank you so much. The Green Impact Exchange is just, it's such a thrill for us to be part of the discussion, let alone being able to contribute to it as we hope to continue to do. But again, thank you guys so much. I will encourage people to visit us at tradegix.com and send us any questions. Be happy to even connect you with any of the panelists if you have questions for them. Post this. But again, thank you so much, and let's keep the optimism going. So again, thank you all so much. And Green Impact and the pushback on the pushback on sustainability signs off. Thanks again.
Thank you.
Thank
Thank
you.
you.